there's a lot that's uncertain in 2025. One thing we do know, however, is the direction of travel in US politics. Trump 2.0 changes the market dynamic, tax cuts, tariffs, immigration curbs and less regulation. It could lead to more divergence, making asset allocation challenging and important. The US economy has been more buoyant than its competitors in recent years, but much of the Trump bump is already priced in. Inflation might be a bit higher than expected, but shouldn't be far above target. Interest rates can still come down through the year. Equities continue to look like the asset class of choice as earnings pick up the baton from valuations, even if long-term return expectations have moderated. The bull market is closer to its end than its beginning, but it's not yet flashing red. So my fund picks aim to participate in the Trump trade while tilting away from the higher priced parts of the US market. As last year, my preference is to be well diversified. I'm looking to tap into the value that's still to be found in financial markets beyond America's tech stock leadership. So, here are my fund picks for 2025. Playing the Trump trade theme, my first pick is the Brown Advisory US Smaller Companies Fund. Deregulation, tariffs and tax cuts should favour smaller, domestically focused US companies. While these stocks have underperformed the tech giants over the past 2 years, that means valuations are less stretched. Brown Advisory is US-based with an extensive research team and experienced managers who favour a conservative approach to bottom-up stock selection. They have hundreds of choices in the US small cap space, with the potential to grow into bigger, successful companies. My second pick is the Dodge & Cox Worldwide Global Stock Fund. This gives me global equities exposure, but with a significant underweight to the US, while being overweight UK and Europe. It's a value-focused fund, but one that takes a pragmatic view. They can own growth companies, but only when they're cheap. The management team, been there and done that through many cycles, evidence of a consistent process and long-term investment skill. Performance has been steady with low volatility, and at 12 times price to earnings, the portfolio has headroom for growth. As interest rates gradually fall, investors will increasingly look beyond cash to generate income. My third pick, the Fidelity Global Dividend Fund, has delivered steady growth despite being underweight US equities. Dan Roberts, who's managed the fund since 2012, prefers cheaper European markets. Dan looks for a margin of safety in his stock picks, and this strong valuation discipline means just 40 make the grade in this high conviction, low turnover, low volatility portfolio. The final pick this year is a play on the new UK government's focus on infrastructure and public investment. International Public Partnerships Limited is a trust that invests in essential, low-risk infrastructure, schools and hospitals, transport and renewables, stuff people rely on for their daily lives. These investments tend to be in partnership with government and generate steady, inflation-linked returns. The dividend yield stands at 5.8% and has been growing every year since 2006. IMPP is currently trading at a significant discount to its net asset value. It could potentially be an entry point, with the trust disposing of assets to work capital harder, reducing debt and buying back shares to narrow the discount. So that's it. These are funds which I hope will do well in the year ahead, but more importantly, I believe they'll be good long-term investments, which I include in my own ISA and SIP.